Your charts are cluttered with indicators, and that is exactly why you're losing money. Now look, I've tried it all. Bollinger Bands, RSI, MACD, any indicator you can think of, I've probably used it. But here's the thing. Whilst my charts look like a Christmas tree, my account looked like a charity case. But here's what changed everything for me. I deleted every single indicator and started reading pure price action. Now I can look at any chart and tell you exactly what the smart money is doing, where price is likely to go, and what I can do to take advantage of that. So in the next 15 minutes, I'm going to teach you exactly how I can read any chart and make sense of what's going on underneath the noise in order to make over £16,000 last month alone. Now, first of all, I want you to understand something. When you're looking at indicators, you are always going to be one step behind what the market is doing. And the reason for that is every indicator that you see on the chart here is what is known as a lagging indicator. It updates after the move's been made so that by the time you see the pattern or the trend, you're already one step behind. And that is why we need to understand exactly how to use price action. So we delete any indicators off the chart and we can look at the chart and how it's moving in real time to understand where price is likely to go. Now, the first and most simple step to identify price action is by understanding market structure. Market structure is something that is extremely simple, but allows you to understand where the trend is going, where the market is currently heading to, and if it's going to continue in that direction or not. Now, an easy way to understand this is to drop to the higher time frames just so you can actually get an example of what the price is doing and be able to read charts in a cleaner fashion. Now, as you can see right here, price is making something called a lower low and a lower high as we continue down like this. So as you see this, you can quite clearly tell the market is continuing downwards. And when you see something like this playing out, we know that 90% of the time the trend is going to continue, and you can shift your bias depending on that in order to be looking for sells if the market structure is bearish. But we can also utilize market structure to understand when there might be a shift in direction. So as you can see here, we actually have a higher high being made here on the charts. Now that essentially means that each high being made is essentially higher than the previous one, and we also have a higher low here, which means that that price is higher than the previous low being made. So in order to be able to read market structure, you need to understand things called a higher high and a higher low. Now, this is one of the most simple concepts in the market, but if you can master it properly, you're going to be extremely good at understanding general direction. Now, essentially what a higher high and a higher low is, and also a lower high and a lower low, is essentially markets putting in little stops in between movements, which gives you an idea of direction. So as you can see right here now, as we're coming down on this market here on the 4-hour time frame, we are putting in a lower low, a lower high, and then continuing to do this on the way down. And you can mark it up like this just to be a little bit more clear. But as you can see, the first low that we put in is right here. So this is what is known as a lower low. Now, the moment you put in another high right here, we can see that this high is lower than this previous high to the left. So this is what is called a lower high. Now, essentially, as long as the market is making lower highs and lower lows, you can understand that we are in a bearish market and price is likely to continue down. You can see right here, it does the exact same thing, puts in another lower low right here, followed by another lower high. And that shows you we are in a bearish market continuing down. But we can also use market structure to identify when there has been a change in direction. So if we're in a bullish market, what would you expect to see? You would expect to see higher highs and higher lows. Well, as we're continuing down here and making these lower lows and lower highs, the moment you start to see a change in that structure and you begin to make a higher high followed by a higher low, this is an indication that we are actually changing the direction of the market and we are looking to continue upwards here. So as you can see, as we were coming down, we were making a high here, and we're making lows all the way down here. Now, the next high that was put in actually comes over to here and is higher than that previous high. So now you have something called a higher high. Now that is essentially my first indicator of a bullish trend, but I'm not taking anything off of that just straight away. Secondly, we have another low being put in. And as you can see, this low right here is a lot higher than this low here. So now you have a higher low. And essentially, this is an indication for me that once you continue up and make another high, you are now in a bullish trending market. So we can understand, first of all, the initial direction of the market, but also how to understand when that direction has changed and we might be having a structure shift. Now, before we move on to the actual entry models that I'm going to teach you, I want to show you liquidity. Now, liquidity is the next construct, but it is easily the most important concept in trading. Now, liquidity is essentially how the market is able to move, the power the market is given to move, and essentially something that allows you to push in a certain direction. Now, the general rule and my golden rule of trading is whenever you are looking to enter a position, you must make sure that you have grabbed liquidity from the opposite direction of the trade you're in. For example, as you can see right here, before we have this actual reversal down here, you have a large bottom wick being grabbed and it actually breaks all of the lows, which is liquidity. The same thing happens here. You have a large bottom wick before a continuation up. Again, liquidity. Now, how do you actually spot that though? Well, there are numerous ways for us to grab liquidity. Now, the first one is, like I said, sweeping lows. Now, you have lows that are put in on the market down here. You have a wick low here as well as a wick low here. And essentially, the way the market works is there will be orders sat somewhere below this level right here, which people are willing to buy at this price. Now, once those orders are filled, that gives the market liquidity in order to push back up and essentially enables you to move in the market. So once you've swept a low and reversed and rejected, that is my confluence to indicate, okay, we have enough volume to push up. This is okay for me to get into buys. Now, essentially wicks is the other condition, right? The other condition to enter into the market is using wicks. So essentially you can see right here, again, we sweep the lows, but even if we hadn't, a large bottom wick is enough for us to actually grab liquidity because a bottom wick like this is showing a quick spike down into an area followed by a rejection and a continuation up. And the only way that rejection can actually happen is by orders being filled and liquidity being grabbed. So again, if you're looking for a buy position, you're going to want to be seeing a wick down to the bottom side in order to grab that power, grab that liquidity to position us upwards. So now we have two confluences here. We have market structure and we have liquidity. Now, the final confluence we need to be entering into a trade is volume. Now, most people, when you talk about volume, they're going to head straight over, type in volume on the indicator thing and put this little thing right here. But as I discussed earlier, this is a lagging indicator. It is going to be behind the market. And by the time that volume's already come in, the move is already going to have been made. So we need to understand how to identify volume on the actual charts as it is happening. And the only way you can do that is by sitting there and watching. So you can sit and watch and say, okay, is the candle moving aggressively? Are we moving up and down? Are we moving about? Now, this is not the same as pushing in one direction or the other. You can have a lot of volume without having strong direction. Maybe the chart is just aggressively pushing up and down, but the moves are made very fast. Or obviously it could be in one direction, but we need to understand where the volume is coming from. And essentially that is going to be from opening times of the market. So you have New York open, London open, and also the closes of the market. New York close, London close. Now I have a little indicator here. Don't get excited because it's an indicator. This is just indicating the session time so that you guys can see it. But as you can see, when these opens occur, you start to have extremely large candles because there is volume pushing into the market at these times as the banks begin to trade. So you want to be trading somewhere around these times, somewhere around New York open, COMEX open, London open, whichever suits you and your time frame. But that is one way that we can essentially identify volume. And secondly, just by using your eyes, okay, looking at the chart and seeing whether it's moving aggressively or not is a very, very easy way. Now, when you have something like this where we begin to consolidate, the candles become very small and there's no real movement in the markets, that is a very, very good sign to tell you, okay, there's not much volume. We should probably be looking to stay out of the market. Now, obviously, once we have these confluences and we are understanding how to read the market, you need to actually be able to grab some entries. So I'm going to give you one final confluence that's going to be the one that I actually enter my trades off of. And that is going to be support and resistance breakouts. Now, support and resistance is exactly how the market rejects off of specific levels, and it is repeated over and over throughout history. So how do you find your support and resistance levels? Well, as I said, it's repeated in history. So the only way we're going to be able to do that is by going to the left of the chart. Now, as you can see, we're starting to have areas on the chart where price is rejecting over and over and over. It does it here, it does it here, here, and here, and here. And then if you come to the left a little bit, it does it exactly here as well. So you can see we are having the same area being rejected off of numerous times. And what does that mean? That means that there's most likely a resistance at that level or orders being placed there that is going to stop us from essentially pushing through. So what we're going to do is place a line on the body of a candle within that area, which is most likely going to be here. But because we are actually below this area right now in price, I'm just going to move it up a little bit. And as you can see, it is aligning with all these areas. You want it to look as clean as physically possible. And if price is below this area, then you're actually going to want to be moving it up to make sure you're not including any of these things. Now, there is enough room realistically for me to take a position outside of this range, so I'm okay with leaving some form of candles outside of it. But realistically, you want to essentially avoid anything where you have a little breakout above, because otherwise price could close above and reject down like that. Now, I'm happy with this level, but what do we need to do after that? Well, obviously we need to find a support level. Now, for me, using the same confluence, you're most likely looking at a level somewhere around here, as we can see all of the rejections like that. So that is a fine level, but that doesn't tell me how I can take a position. How can you take a position when you're looking at support and resistance levels? Well, there's one way that is actually the easiest way that I'm going to teach you right now, and that is by looking at something called a breakout. Now, a breakout is when price action closes outside of this range and essentially closes above a resistance level, which indicates that you are essentially respecting the next range. Now, the next range would be wherever the next resistance level is. So using this, I'm just going to simply put it here. And essentially what happens is once you close outside of one resistance level and into the next range, which would be this range right here, you are expected to fill at the next range. So price 90% of the time is going to come up and fill at the next range all the way towards the top. Now, what we're going to be doing is essentially looking to take a position, provided that all our confluences are there, taking a position after a breakout up towards that next range. And that is essentially going to be an extremely simple way for you to take advantage of the market moving. Now, what is actually going to happen here is we are going to need specific things to play out. We can't just wait for one specific closure, but we're going to look at essentially waiting for a breakout of the candle above this area and then a liquidity grab like we discussed earlier. And once we get something like that in the form of a bottom wick, we can essentially take a trade like this, taking that candle up from here towards the top of the next range, imagining obviously that this was our level. And it's an extremely simple way for you to trade, but yeah, take advantage of a large move throughout the market. Now, the other way that you can take advantage of price action, and this is a trade that I actually had taken earlier, was extremely simply just by waiting for a range to be tapped from the bottom. As you can see here, we like to sometimes push in between these ranges and just consolidate. And you can wait for, exactly like I said, a liquidity grab outside of the range, so breaking these lows. Combining that with market structure, as you can see on the 4 hour, we were actually coming down and making a higher low. So we had essentially switched bullish. As well as that, understanding that we actually had volume here because this was around London Open at 8 o'clock. And once that candle grabs liquidity by sweeping these lows right here and rejecting, closing bullish back into the range, which is a confirmation that we are now respecting this support level right here, all you have to do is immediately place a buy because we've grabbed enough liquidity on this area right here. Stops can be below this level right there. And you can actually take that trade all the way up towards the top of the next range, exactly like we said. Now, I took this exact trade this morning for a total of $500 profit, but I did actually close it a little bit early because I saw some things that I didn't like. However, the full TP is about to be getting hit right here, which would have been a very, very nice 1.5 risk to reward and a clean position. Now, as you can see, these confluences line up perfectly and they give you a very, very strong understanding of where the market is likely to go before it's even made the move. So you're not having to rely on a EMA tap or a Bollinger Band or something that's going to be moving after the market's actually made the push. You can actually take a position using price action live in the market already. Now, I just want to quickly show you here how important that liquidity grab is, because as you can see right here, a lot of traders may have expected at 7:45, this little 15-minute candle right here, grabbed a nice bottom wick and then closed respecting, and they'd be looking to take that position. However, we haven't broken these lows and we haven't essentially waited for enough orders to be filled down below here. So even if one of these confluences is missing, you are not going to get the same results. As you can see, we did get that bottom wick and we did get a strong closure above. First of all, London Open was 15 minutes from this time. So essentially the volume might not have been there until that 15 minutes later when London opened. Secondly, you didn't actually get the sweep of these lows. You didn't get these orders that were resting below this wick right here being filled. So you actually did not have enough volume to make the push back up. Even though you rejected right here, there was not enough volume. So a patient trader would have waited for that 8 o'clock open, waited for that sweep of those lows right here, and essentially waited then for that next 1 hour closure to happen. And once that happened, that is a very strong indicator, again, that we are looking to push up. So that is my second entry model. So the first one that I showed you, essentially looking at a breakout above this range and a continuation up. But if you can understand price action and essentially understand where we were in the market structure, you had a very, very clear right here, a lower high being made after making a higher high right here. So you are at least looking to retest these highs right here, but understanding that and dropping down to the lower time frames, this is where my multi-time frame analysis comes in, because we were using higher time frame direction, but we zoomed in to the lower time frames in order to actually take the entry. And this brings me on to my next point, which is understanding only one time frame is not going to be enough for you as a trader. Now, essentially, being able to read multiple timeframes and get a three-dimensional picture of the market is the best way for you to become profitable. Now, what do I mean by that? Well, exactly like I just showed you, if the 4 hour, the 1 hour, everything aligns, but maybe the 15-minute is incorrect, you are still going to get wrecked. So you need to be looking at every single time frame in order to actually take advantage. Now, the first rule of this is very simple. The higher time frame takes precedent always over the lower time frame. So for example, if you have a breakout on the 15-minute, but the 1 hour hasn't set up just quite yet, you need to wait, because the 1 hour is the stronger time frame, it's the stronger confirmation, and waiting for that is going to give you a much higher probability trade than taking it on the 15-minute and hoping that the 1 hour lines up. So that's step number one. Step number two is essentially understanding what an A+ setup is with this strategy. Now, an A+ setup would be literally every single time frame aligning. For example, the trade that I took this morning. The daily bias is bullish. The 4 hour was making that lower high and had closed bullish previously. The 2 hour was the exact same. The 1 hour had made that sweep below the level and closed bullish, followed by obviously the 30-minute doing the exact same thing, and as well as sweep of the lows on the 15-minute and a market structure shift. So essentially we had every single confluence I could need using every single time frame. But if one of these time frames didn't align, I either would have dropped my risk if it was a lower time frame, or if it was one of the higher time frames that was out of alignment, I would have not taken the trade entirely, because I understand that the higher time frame is going to play a lot of a bigger role on the direction than the lower time frames, and I need to wait for that higher time frame to align in order to be taking successful positions. Now, how can you be practicing this? Well, I want you to go away from this video and first of all, just spot all of the confluences that I've mentioned. Write down every single confluence that I've mentioned right here. So you've got the direction, the market structure, you've got the liquidity, the volume, as well as the support and resistance and the breakout or the tap into the range, right? Those are the 6 things that I've mentioned throughout this video that are going to be essentially key confluences that allow you to progress in your trading. Now, once you've done that, you need to be understanding exactly how you can utilize these in the market and watching it happen in real time. So go and analyze the charts, whether you're trading a funded account or a demo account, just look at it, take positions and essentially test these things out. If you want to back test it, then great. But you can quite clearly see when you start to identify these little structure points, it becomes second nature. So just go and mark out your charts, identify the highs and lows, like I said, identify the liquidity grabs exactly like I drew on the charts, and it gets to a point where it becomes second nature, and you're going to start seeing these things every single day in the charts, seeing patterns appear, seeing things repeat, and that is when you can actually identify them and then go ahead and make your own setups from them that you can utilize as your own entry models. Because that is the end goal right here. The end goal is to give you guys the keys to the castle in order for you to actually go ahead and take setups using your own entry models that you've developed yourself off of data. Because if I give you my cookie cutter strategy, which I'll happily do, you can trade that, but it is not going to be yours and you're not going to align it with yourself, and it's going to be a lot more difficult to spot them and trade them rather than something that you've developed yourself. Because as we all know, your eyes are going to see something different to mine are going to see something different to someone else. So when you can actually spot something yourself, it's going to be a lot easier to go away and actually take positions using it. And that is exactly how you can read the charts like a book. Now listen, this is just scratching the surface on everything you need to know about market reading, getting rid of all of that noise, and actually make money in the markets by speaking the language of the charts. Now I'm going to be doing a full live webinar inside my free WhatsApp group within the next week, so make sure you've joined that by clicking the link in the description below. Other than that, that is going to be the entire video. Hopefully you enjoyed. It was an absolute masterclass on how to read the charts. So make sure you go and watch it again if you don't understand everything. Take notes and implement it in the charts. And other than that, I'll see you guys in the next one.